One way for beginner investors to get started is to buy ETFs that track broad market indexes, such as the S&P 500. In doing so, you're investing in some of the largest companies in the country, with the goal of long-term returns. Other factors to consider include risk in the fund's expense ratio, which is the amount you'll pay in fees every year to own the fund. The lower the expense ratio, the less it will eat into your returns. How to buy an ETF. I will tell you how to identify the best ETFs for you and how to buy them in just a few steps. Number 1. Open a brokerage account. A brokerage account is your gateway to the stock market. The type of account you choose depends on your financial goals. If you're buying growth ETFs to invest for retirement, choose an individual retirement account, IRA, which offers valuable tax benefits but limits your annual contributions. For more near-term goals, go with a taxable brokerage account. You'll need a brokerage account to buy and sell securities like ETFs. If you don't already have one, see our resource on brokerage accounts and how to open one. This can be done online, and many brokerages have no account minimums, transaction fees, or inactivity fees. Opening a brokerage account may sound daunting, but it's really no different than opening a bank account. Number 2. Find and compare ETFs with screening tools. Once you've opened a brokerage account, research the ETFs most likely to help you reach your goals. Most growth ETFs track the performance of growth stock indexes and are priced very competitively. But some are active ETFs, where fund managers pick growth stocks and frequently rebalance the fund's portfolio in an attempt to beat growth indexes. This is a more expensive approach, but it can offer greater returns. It's time to decide what ETFs to buy. Whether you're after the best performing broad index ETFs or you'd like to search for others on your own, there are a few ways to narrow your ETF options to make the selection process easier. Most brokers offer robust screening tools to filter the universe of available ETFs based on a variety of criteria, such as asset type, geography, industry, trading performance, or fund provider. There are thousands of ETFs listed in the US alone, so screeners are critical for finding the ETFs you're looking for. Administrative expenses, also known as expense ratios. These expenses cut into profit, so lower is better. According to Morningstar, the asset-weighted average expense ratio for passively managed funds was 0.12% in 2020, so this could be a good number to start with in your screener. You'll find, though, that some popular ETFs have expense ratios much lower than this, so don't be afraid to screen for below the average. Commissions. These are fees you pay per transaction when you buy or sell an ETF. Fortunately, commissions are virtually non-existent in most major online brokers these days, but it's a good idea to check before you buy. Brokers that charge a commission often offer select ETFs commission-free. Volume. This shows how many shares traded hands over a given time period. Holdings. You'll be able to see the top holdings in the fund, which simply means the individual companies the fund invests in. Performance. You know the saying, past performance doesn't indicate future returns, but it still can be useful to compare the performance history of similar funds. Look at a fund's long-term performance, so 5-year instead of 1 year for example, to get a sense of how it has performed historically. Trading prices. ETFs trade like stocks. You'll be able to see current prices, which dictates how many shares you can afford to buy. Number 3. Place the trade. You'll need to transfer cash into your brokerage account in order to buy shares of growth ETFs. Search for your chosen ETF by ticker symbol. Some brokers make it easy to buy shares right in the ticker research section. If not, you'll need to go to the trade section of the brokerage and enter the ETF ticker. Enter the number of shares you want to buy. In most cases, you enter a market order, meaning your purchase request goes through at the current price of the ETF instead of holding out for a particular price. Use a limit order to get growth ETF shares at a specified price. The process for buying ETFs is very similar to the process for buying stocks. Navigate to the trading section of your brokerage's website. In this context, trade means you're either buying or selling an ETF. Before you execute your order, you'll have an opportunity to double-check that everything is correct. Make sure your order is set up as intended. Check the ticker symbol, order type, and that you haven't made a fat finger error. For example, typing 1,000 shares when you intended to buy only 100. Number 4. Sit back and relax? Congratulations! You've just bought your first ETF. These funds can help form the basis of a well-diversified portfolio and serve as the first step in a long-lasting investment in the markets. There's no need to compulsively check how this ETF or your other investments are performing, but you can access that information when you need it by checking the ticker symbol on your brokerage's website, or even just by typing it into Google. The best ETFs for the long term hold a diversified portfolio of stocks while charging a very low ETF expense ratio. While many funds share those two key characteristics, here are the top ETFs for long-term investors. Number 1. Vanguard S&P 500 ETF. The Vanguard S&P 500 ETF is an index fund designed to track the S&P 500 index. That index represents 500 of the largest U.S. publicly traded companies. This ETF's goals are to closely follow that index's returns, which is the primary benchmark for the overall returns of the U.S. stock market. It offers investors a high potential for investment growth, making it an ideal long-term investment. Like the S&P 500, this ETF uses a market weight strategy, giving a higher weighting to the largest companies. As a result, its top 10 holdings made up more than 30% of its total net assets in early 2022. That gives investors relatively concentrated exposure to the largest companies in the index. This ETF offers investors exposure to the largest U.S. stocks for a very low cost. Its ETF expense ratio of 0.03% is significantly below the industry average expense ratio of 0.24%. In other words, investors would only pay $3 in annual management fees per $1,000 invested in this ETF compared to $24 per year for every $1,000 invested in the average ETF. Number 2. Invesco S&P 500 Equal Weight ETF. The Invesco S&P 500 Equal Weight ETF is also an index fund designed to track the stocks in the S&P 500. However, it uses an equal weight approach instead of one based on market cap. As a result, this ETF's top 10 holdings represent just 2.5% of its total assets. This approach reduces concentration risk by providing broad exposure across the 500 stocks in the S&P 500. This ETF rebalances its holdings quarterly to ensure each holding remains a relatively equal portion of the fund's assets. This ETF has a relatively low expense ratio of 0.2%. That's a reasonable fee to gain broad equal weight exposure to 500 of the largest public companies in the U.S. Number 3. iShares Russell 1000 Growth ETF. The iShares Russell 1000 Growth ETF provides exposure to U.S. companies expected to increase their earnings at an above-average rate compared to the broader stock market. The fund held shares of about 500 companies as of early 2022. This ETF takes a market-weighted approach. Because of that, its top 10 holdings made up almost 50% of its total assets. Given its growth focus, technology stocks make up a significant portion of the fund's holdings. Overall, the information technology sector accounted for 46% of the ETF's holdings. This ETF charges investors a reasonable expense ratio of 0.19%. That's a fair price to pay to gain long-term exposure to growth stocks. Number 4. Vanguard Real Estate ETF. The Vanguard Real Estate ETF invests in real estate stocks, with a focus on real estate investment trusts. These entities typically own income-producing commercial real estate such as apartments, office buildings, retail properties, and industrial complexes. As of early 2022, this REIT ETF had 164 total holdings. The top 10 made up 44.7% of its assets. However, it's worth noting that its largest holding was a real estate index fund also managed by Vanguard, which helps reduce its overall concentration. This fund charges a relatively low fee of 0.12%. That makes it an inexpensive way to gain exposure to the real estate market, which has historically been an excellent long-term investment. Number 5. Schwab U.S. Dividend Equity ETF. The Schwab U.S. Dividend Equity ETF tracks an index focused on holding dividend stocks known for the quality and sustainability of their dividend payments. This ETF enables investors to benefit from the power of dividends in producing attractive total returns for investors over the long term. This ETF held shares of more than 100 dividend-paying stocks in early 2022. The fund offered a dividend yield of around 3%, about double that of the S&P 500. Its top 10 holdings made up about 40% of the total. Meanwhile, its overall holdings are weighted heavily in the financial sector, 21.1% of the fund's holdings, and tech stocks, 20.5%. This ETF charges an ultra-low expense ratio of 0.06%. Because of that, investors keep a significant portion of the dividend income this fund's holdings generate. This is all for today. Thanks for watching, and don't forget to like and subscribe my YouTube channel. Stay tuned for watching more informative videos like this.